Hello and welcome back to Principles of Macroeconomics. I'm your host, Dr. B. Today we're going to be talking about aggregate supply and demand. Before we jump into today's discussion, I want to quick housekeeping notes for you all. We are in week 15. Oh, 14, just kidding. We're in week 14 of the 16-week course. What does that mean? We're going to cover aggregate supply and demand today. We'll also talk about influence of monetary supply in the next chapter. We'll also do that today. So 2 chapters today, 2 chapters next week. And then week 16 is the final exam. This class officially ends December 5th. Class officially ends December 5th. I can already hear you, Dr. B. It's like, the end of next week. It is the end of next week. You're right. So we have 2 assignments that will be due this Sunday night, 2 assignments due next Sunday night. And then it's it. That's all she wrote. And then you'll take your final exam. The final exam covers the second half of the course. So if you think about the final exam, it'll cover weeks 9, which is chapter 12. So it'll go from chapter 12 all the way to chapter 23. 12 to 23, final exam. Final exam, it's really not that bad. It's like 20 some odd questions, mixed true, false, multiple choice. I made sure to take it easy on you with respect to the math questions. It's mostly based on terms. If you review the PowerPoint presentations, make sure your book is open, review your notes. You might want to even go back and review previous quizzes and homework assignments. Promise you, if you do those things, you'll do very well in the final exam. Final exam, if I'm not mistaken, is 20%. So it'll be all right, I promise. We'll talk a little bit more about that next week. Okay, so let's go ahead and jump into today's lectures since they can be a little bit lengthy at times, but I don't think they will be, honestly. The concepts are pretty straightforward to understand. So let me go ahead and make this a little bit bigger, and we'll talk about aggregate supply and demand. So we all know what the supply and demand is. Supply is the amount of goods and services available for sale at a certain time during a certain time period at a particular price. Demand is the willingness to buy of the consumers at a particular price at a particular time. That's supply and demand. We know what supply and demand is. We've been talking about it for the past couple of weeks. What is aggregate supply and demand? So let's jump into it. From year to year, the economy goes up and down. Absolutely it does. It's called fluctuation. That's what economic activity is. It's when the economy or economic activity goes up and down from year to year. The economy will oftentimes, well, not often, but once in a while experience a recession, depression, or a boom time. Or times when the economy goes up. Economy goes up, economy goes down. That's normal. When the economy goes down a little bit, it's said to experience what we call recession. A recession happens when economic conditions worsen, when there is a decline in incomes and unemployment goes up. That's called a recession. We had a few of those. Most notably, the Great Recession from 2007-ish, 8-ish to 2010. It was called the Great Recession because of how deep it went. It wasn't as bad as a depression. A depression is basically a severe recession. The Great Depression, after the stock market collapsed in 1929, was probably the worst in recorded history. We have had severe recessions, but not to the point of depression. The era of 2007, 2000 to 2010, that some economists could consider that to be a depression because of how long it lasted. But really, it was more of just a really bad recession. The most recent recession we've experienced was last year, this past 2020. We experienced a sharp recession, because the economy closed up. Everyone had to stay home. So people stopped spending money, right? Unemployment skyrocketed. There was a severe recession, almost a depression, but it quickly snapped back. It bounced back so quick that people were it was beyond disbelief. Yeah? So 2020, we had a recession. It lasted about March 2020 to about the beginning of 2021, roughly. So not very long recession. So that's what a recession, that's what a depression is. They're economic fluctuations over time. The economy can be somewhat unpredictable because the business cycles are somewhat unpredictable. We sure as heck didn't expect a worldwide phenomena to cause a recession like it did in 2020. But all of the economies fluctuated together, causing severe unemployment, causing less people spending money. So that's what happened in 2020. It's called a worldwide phenomenon, recession, because the whole planet experienced it at the same time. That's why they call it a phenomenon. So as output decreased, meaning less economic activity, less manufacturing, less consumption, unemployment goes up. That's what causes recessions, yes? And we can see over time what happens with respect to recessions from time to time. This graph represents GDP from 1970 to 2015. We can see that typically there are the economy's it grew. There was growth rates for the most part. The ones in red, the parts that are in red here, these are recessions. A recession is when gross domestic output decreases, which also means that unemployment goes up. Unemployment goes up, less economic activity, right? That's a recession. So if this graph were to continue forward, 2020, we would see another one of these red lines. Decrease in economic activity, increase in unemployment. And then, of course, 2021, it will go back up. So it'll be a really small red sliver for 2020. We can also see what happens to investing at times of recession. The worst decline we can see 2007, 8-ish to about 2010 was the Great Recession. Great Recession because high unemployment rates, low economic activity, very difficult time in the United States. We can see what happened to investment spending during that time. It plummeted. Why is that? Well, nobody's going to go buy a second house when most people don't have jobs, right? So we can see what happened to investing. Investing typically follows the same trends. When there's a recession, there's going to be less investment spending. That's very obvious. We can also see the trend line with respect to the unemployment rate. At the time of a recession, unemployment goes up. That makes perfect sense. That's what is involved with this dichotomy. We have real variables and nominal variables. We discussed this a little bit last week, if I'm not mistaken. We have real variables, which are variables that have an impact on the economy, and we have nominal variables, which are kind of like blips. They're minor in comparison changes that happen in the economy. The real ones are things like unemployment. They're things like interest rates, etc. The nominal things are things that change incrementally. The thing to understand about short run economics, which are impacted through recessions, is the short run simply means during the short time period. Okay, short run. So when you think short run, think a year or less. That's the short run. The long run, greater than 1 year. It's similar in accounting, as you recall. In accounting, we talked about current and long term. Very similar in economics. Current is short run. Long term is long run. It's basically the same concept applies. When there are changes in the amount of money in circulation, it has an impact on the nominal variables. There's small effect. It doesn't have impacts on things like unemployment, which are the real variables. Unemployment and the amount of money in circulation, those two really aren't very well correlated. So there's no real you can't show a relationship between the amount of money in circulation and unemployment. Those two don't correlate well. So that's why unemployment really follows a real variable, and the amount of money in circulation is a nominal variable. In the short run, we talk about like small changes, like things that might change sharply and then fix itself quickly. Kind of like the current situation with inflation. Is it short run inflation? Maybe. I I I don't know, to be honest. With the current one, I think that this inflation might be here to stay for a little bit longer. I hope not. I hope it'll stabilize, but it's hard to tell. So it could be long run, but hopefully it's short run. Short run again, less than a year. Long run, longer than a year. Some things are more long run than short run. Like money supply, changes in the money supply. If there's short term changes like the interest rate, uh, minor price adjustments, minor impacts with GDP due to like a small manufacturing blip or something like that, that's short. But it could be long run. If it has an effect in the long run with respect to the amount of money in circulation because of a bill that was passed, or the amount of money in circulation because of the balance sheet from the Federal Reserve, that could be a long run effect. That could be a long run effect, and which ultimately might impact inflation. But still, typically, any type of change in the money supply, there's not going to be effect on GDP or unemployment or other real variable rates. Remember, unemployment, that's a real component of the economy. Nominal components are things like money supply, interest rate, small incremental things. So when we talk about fluctuations, recessions, growth periods, and we talk about things like the short run with money supply or real and nominal variables, we look at how they're related. In the short run, short time frame, the money supply doesn't have an effect. What does always have an effect are things like unemployment, uh, to some degree, interest rates, which are the real nominal variables. Those can have an impact on the short run. Some changes in the money supply can be tied to GDP, but it's typically short run and it's typically temporary. So if we look at, for example, if we look at the current inflation situation, year 2021, we realize that it's probably temporary. It's an effect of a couple of things. It's an effect of the pandemic. It's an effect of the market forces at play, supply demand. Partially true. It's also an effect of the amount of money in circulation. Partially true. It'll be adjusted in the short term, but it will have an impact on the gross domestic product, GDP. So as we examine short-term fluctuations in the economy, we also look at this thing called aggregate supply and demand. Aggregate supply and demand. When I talk about aggregate, the aggregate of anything, think about the term aggregate from a statistics perspective, the aggregate, the grouping of demand and supply in the short run. And think about how there are trends in the short run, how supply and demand gets affected in the short run. Oil prices, classic example. Gasoline prices, classic example. Gasoline and oil prices are typically tied to economic fluctuations of supply and demand. That's aggregate because it's in the short run. Prices are typically not stabilized long term or in the long run when there is economic volatility. So as we look at the aggregate of supply and demand, first we'll look at the aggregate demand. It shows us the quantity of goods and services that households, goods, firms, government, blah, 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 want to buy at a particular price during a particular time. Hence demand. Remember, demand is the people that are looking to buy goods and services at a particular price during a particular time. That's what demand is. But it shows us the aggregate, the group of people together, households, firms, government, international customers. As you know already, the demand curve is downward sloping to the right. Supply, as you know, is the quantity of the goods and services available for sale at a particular price during a particular time. And supply curve is upward sloping and to the right. Remember, demand, downward sloping to the right. Supply, upward sloping to the right. And what's at the middle? What's at the middle? Who can tell me what's at the middle of supply and demand, where supply and demand meet, is called the point of, don't all say it at once, equilibrium. Thank you, Dario. Point of equilibrium, exactly right. Point of equilibrium. Equilibrium is where supply and demand meet. So it really follows the same exact simple concept of supply and demand. Aggregate simply meaning the grouping of. Right? So we see the aggregate supply and demand curve and where they intersect. It would be the aggregate point of equilibrium, which is the equilibrium output. So here's the formula that you all love so much. Very similar, very similar formula to what we learned about demand curve. So the aggregate demand is represented by wealth effect consumer spending plus the interest rate I plus government spending plus NX, which is, as you recall, what's it called? That NX exchange rate, but it's net. That's something. Help me out here. What is NX or NE NX, right? It's the net output, the net NX. What is NX? Remember from last week? NX. It's the net sending it out of the country. Remember exports? Net export? Yes, thank you. You got it. So consumer spending plus interest plus government spending plus net export. Yes, all of those things. With the aggregate, it's the wealth, which is basically a consumer spending, plus interest rate, plus government spending, plus the exchange rate. And those three things together, those four things together will give us the aggregate demand. At C, which is consumption, price levels in C, consumption. Consumption and wealth. It's really the same. When somebody's said to be wealthy, it means that they're spending a lot of their income. Hopefully their income, not somebody else's. When someone spends a lot of their income, they're considered to be wealthy because they spend money on goods and services and etc. Consumers are wealthy when they spend their income, right? That's what wealth is. Well, kind of. But wealth can be changed. It can go down in price based on the increase of value of money. The consumers are wealthier when the price levels go down. There will be an increase of consumer spending when prices go down and an increase of quantity, demand, goods, and services. That's what happens when the price goes down. So, in other words, the more wealth you have, if the price goes down on the things you buy, the more you'll buy of it. Or at least that's the idea. Price goes down, people spend more. Price goes up, people spend less. Just like anything else these days, right? If the price of gasoline were lower, people would drive more. But now that the price of gasoline is higher, people drive less. Very straightforward. Now let's talk about pricing and investing. Investing, as you know, is when people invest in something. It could be houses, it could be stocks and bonds, it could be, whatever else you invest in. So if the price goes down on your investments, there will be a lower interest rate. You'll invest more if the price is lower. So if, like, for example, the price of housing goes down you might buy more houses because it's a lower price, it's a lower interest rate, and there will be an increase of demand for housing, as one example. When you're investing in something, you want to invest at the right price. Typically, you want to invest in something where the price is a little bit lower, like for a house, right? But what about net exports? What happens when there's price changes and net exports? Let's say there's a overall price as the United States goes down. What happens with net exports? Well, there'll be a lower interest rate, which means the U.S. dollar will go down. It'll actually increase net exports because if you think about it, with lower interest rates and a lower dollar value, foreign individuals and companies will purchase more U.S. goods, which will increase exports. And there'll be a higher demand for goods and services. So in summary, when the price goes down, it typically always will increase the quantity of goods and services demanded. That makes perfect sense because anytime a price goes down, people buy more of it. Typically, right? So it's like you go to the grocery store, you realize that oranges are 50 cents a piece, so you'll only buy 2 of them. But if that price goes down to 25 cents a piece, you might buy 4 of them, right? That's just logic. Price goes down, therefore you'll buy more. So there's an increase of the goods and services, and there's also an increase in quantity. Wealth, there will be more consumption. Interest rate will go down, and the value of currency will also go down. But net imports will also increase. And the opposite is obviously true. If the price goes up, there's going to be a decrease in the quantity of goods and services demanded. Consumers won't have as much spending power. Going back to the orange example, if oranges are 25 cents, I might buy 4. But if the price of oranges goes up to 50 cents a piece, I might only buy 2. Right? So I'll be able to buy less. Higher interest rates will stabilize, which means there'll be less investing. And the currency, value of the currency will go up, which means there'll be less net exports. Again, aggregate demand. When you think of aggregate, we're also thinking about shifts in demand, which is represented here. And you can see when there's a shift in the demand curve. If the price comes down from P1 to P2, the demand will be higher, Y1 to Y2. I'm going to want more of it, which means there will be a greater output. When does it shift? When does the aggregate demand shift occur? When there's changes in consumption, investment, government purchases, or net exports, or all of the above. When there's a change in consumption, it means how much people are willing to buy. Changes in prices. Remember, price goes down, the demand goes up. Price goes up, demand goes down. Makes sense. Think of it, when you go to buy something. If the price is higher, you'll buy less. Price is lower, you'll buy more. Simple. Changes in investment. You'll invest more when there's better technology, better tax policy, better money supply. When there's more investing happening, the demand curve will shift to the right. If the opposite happens, meaning the price goes up, technology is a little worse, policy is a little worse, money supply is a little worse, the demand shift will be to the left. Remember, the opposite is always true. Yeah. What about government purchases? When there's changes in government spending at a given price point, there'll be more new roads built when there's lower prices. Right? The government might purchase more. Demand shift will be to the right. If the government spends money at higher prices, they'll spend less on new roads, and the demand shift will be to the left. When there's changes in net exports due to price changes, it's typically due to the fluctuation. Recessions in Europe, international speculation, all of these things will increase export, and the shift will be to the right. The opposite is also true. So we talked about the demand curve, which means now we got to talk about supply. Remember, demand is the consumer's willingness to buy at a particular price at a particular point. Supply is the willingness to sell goods and services at a particular price during a particular time. So let's look at the long run and short run of supply. With respect to the long run of the supply curve, prices typically don't have an effect in the long run, especially on GDP. The supply of labor, capital, natural resources, available technology stabilize. All of those things are stable in the long run. There is no real impact of price changes in the long run. So here's another way to think about it. The supply of gasoline, in the long run, the price doesn't change all that much. Goes up 10 cents, 20 cents, whatever. In the long run. Okay, so if you look at a year, a couple of years, long run, right? Greater than 1 year. From 2008 to 2020, the price was relatively stable. I mean, yeah, it had a couple of peaks and valleys as time went on. But in the long run, the changes in prices were nominal. They really didn't have an impact on gross domestic product. In the short run, on the other hand, the supply curve goes upward sloping. And in the short run, the price changes have an effect. And this is a nice graphical representation of long-run aggregate supply. It's pretty much parallel, vertical. With supply of goods and services, production is pretty natural, meaning in the long run, it's very nominal. There's not a whole lot of changes in the long run. In the long run, unemployment rate is steady. In the long run, supply of goods and services is steady. In the long run, the prices are pretty steady. And at natural levels, there's potential for greater output and full employment. Full employment simply means the entire country is working. Well, with the exception of those that are retired or are too young to work. Full employment means that every citizen that's willing and available to work is working. That's the optimal situation in the United States. We are trying to reach the point of full employment. Will we ever reach it? Maybe. We'll come close. And the potential for the output is great. We have a lot of potential there in the long run, naturally. With respect to the natural level, if there's a change in something like the amount of labor, capital, natural resources, or technological advancements, there will be a possible shift in the supply curve. Because remember, anytime that we impact a supply component like labor, capital, natural resources, all of those things are part of supply chain, right? So when there's changes in that, there's going to be a shift. If for those of you who know me from accounting, I talk a lot about raw materials, direct labor, factory overhead, and all of the things that go into manufacturing a product. The same exact thing applies here. When I have a change in my labor, which is my direct labor, when I have a change in my capital, my cash flow, when I have a change in my raw materials, when I have a change in my factory overhead expenses, there will be a shift in the supply. I might be able to supply more, I might be able to supply less, depending on what happens. When there's a change in labor, if I have more labor coming in, which means I'm reducing unemployment, there will be an aggregate shift in that supply. When there's a change in capital, the amount of cash got coming in, if it increases, we're going to see a shift in the supply curve. When there's physical and human capital changes, there will be a shift in the supply curve. When there are more natural resources available, like for example the discovery of rare earth minerals that are used in technology circuit boards that we currently have a shortage of, by the way. If there's a discovery of rare earth minerals that we can use in the production of circuitry or microchips, that will, of course, drive the cost down, but an increased supply will also shift the demand curve. When there are changes in weather due to climate change, that will shift the demand curve, the supply curve. When there are shifts in the availability of natural resources, that'll shift the supply curve. When there's new technology available that helps us to solve labor situations or capital and resources, it'll shift the supply curve. International trade, government regulations, when those things change for the better, hopefully, they'll shift the supply curve. But looking at the long run, in the long run, things are pretty stable overall. Yes, there will be small waves of changes. There will be an up and down in the economy over time. Yes, that happens. We'll have recessions. We'll have expansions. We'll have recession. We'll have expansion. Hell, we might even have a depression at some point, but we'll go back to expansion. Those are short-run effects. In the long run, over years, right? In the long run, with more technological advances, with more output from the economy, from labor, from capital, from etc., the demand curve will shift to the right. So will the supply curve in the long run. The result of all these things are continuous growth in output with slight continuing inflation. You may hear some economists say that inflation is bad. You might hear some say inflation is good. I can already hear you, Dr. B. Inflation ain't good. I'm paying more. That's true. You are paying more. But inflation in a small degree over time can be good, because that means that there's more economic output happening. To a degree. It's what we're experiencing right now is not good because it's sharp levels of inflation. We're talking 10, 20, 30%. That's bad. But if it's like 2%, 3%, that's actually good. Just not as dramatic. If you think of like the bell curve slopes up, comes to the top, the peak goes down. Okay, that's a bell curve. You all hopefully remember that from statistics. But when that bell curve is a little bit more steady in the slope, comes up, levels up, goes down, a little bit more steady, that's good. That's when inflation actually becomes a good thing. But yeah, as we achieve technological improvements, the Fed increases money supply, or at least controls it. We see growth. We see opportunities to grow. Aggregate supply, the supply curve, is upward sloping and to the right. You know that. That's the direction supply goes. Demand, downward sloping to the right. Supply, upward sloping to the right. When there's changes in supply with respect to price, there's an increase in overall, if there's an increase in prices, and there's an increase in supply and demand, we see there's a decrease in price, decrease in the amount supply. In other words, price goes up, demand goes down, but there's more supply available because less people are buying it. Price goes down, demand goes up. That means there will be less quantity available because a lot of people are going to be buying it at lower prices. Very straightforward economics. We talked a lot about this throughout the past 10 weeks or so, 11 weeks or so. A couple of theories. I'm not big on theories. I don't like theories. I like practice. But I got to tell you about a couple of theories. One's called the sticky wage. Another one's called sticky price. Another one's called misperceptions. The word sticky, it means sticky. It's kind of like, when something gets stuck to something else. We call it pegs, but they call it sticky, whatever, same thing. Sticky wages. Think of like a bubble gum, yeah? You ever get bubble gum stuck to your fingers? Or super glue, maybe? It gets slow to adjust it. It's sticky, yeah? So let's talk about wages. They're slow to adjust to changing economic conditions. For example, we currently have this thing called inflation. Very dramatic inflation for 2020. Wages will not adjust quick enough to make that better. It's just not possible. Okay? So wages are slow to adjust to those types of conditions. They change slowly. That's just how it works, unfortunately. Wages are typically based on expected pricing. They don't respond immediately when the price levels change. So, for example, grocery prices 20% higher, your wages are not going to go up 20% to match that. It's just not going to happen. They might go up a little bit, but they're not going to match those changes in prices. They're sticky. They move slow. Okay? If the price levels are less than the expected amounts, firms might produce less. If the price level is greater than the expected amounts, firms will produce more. Prices of goods and services adjust slowly to economic conditions. Kind of a recession, prices don't go down that much. Okay? When there's inflation, prices will go up, but they won't skyrocket. They stay with an adjustment. Yeah, there's a range. Think of this as being a range when it comes to pricing. Menu costs will adjust based on price changes. If the price of ingredients increases, we pass that price along to the consumers. So, for example, those of you who like Maryland crab, for example, crab prices went up substantially over the past couple of months. So the price on the menu went up to reflect those changes. The last theory is called the misperception theory, misperceptions theory. It's when the changes in the pricing can temporarily mislead suppliers. Okay. When there's temporary changes on the supply side, the suppliers might respond to those temporary changes. Okay? Like, let's say, for example, the price of oranges went down, so I'll supply less of them, right? But then they go right back up to where they were, like a few days later. Well, that's misleading, right? I'm misperceiving that change. So it's when there's too much change. It's almost like an overreaction. It's like, maybe I shouldn't have supplied less because it was a temporary change. It's misperception. Now, of course, another formula that you need to know. For the quantity of output supplied, it needs to be equal to the natural level of output plus the letter A. What does the letter A represent? A is the actual price level minus the expected price level. That is letter A. Actual price minus the expected price. For those of you who are in my 202 class for accounting, it's actual minus budgeted. That's a way to think about it. Short-term run. When there's short-term changes in labor, capital, natural resources, or technology, there will be an expected price level change. When it increases, the supply curve shifts to the left. When the price decreases, it shifts to the right. You guys know that, though. A couple of assumptions. Why do economic fluctuations happen? Why do recessions happen? Why does growth happen? The economy begins long-term in equilibrium. With long-term equilibrium, though, there will be an intersection where the aggregate demand equals the aggregate supply. That's what equilibrium means. There will be a point of natural level of output and a point of actual pricing. Where the two intersect, it's when the expected price level equals the actual price level. Does it happen? Yeah, sometimes. Sometimes. This is what it looks graphically. Very similar what we started this whole class off with when we started talking about supply and demand. When there's a shift in aggregate demand, price, and it's in the short term, the short run, and it's at a time of recession, output goes down, price levels go down. In the long run, if this happens, supply shifts to the right, output will be at its natural level and prices will come down. Remember, long term, it's more natural. It stays relatively consistent long term, long run. Short run, it's a little bit more volatile. Here you go. This is, look at this long-term graph here. 1900 to 2015. How much did real GDP change? Not a whole heck of a lot. Maybe within 10%. The most of the changes happened within 10%, with the exception of a couple of world events. Great Depression, World War II. Yeah. Those were the two largest economic things that happened in the past 100 years. So what causes these changes on the supply side? We know what happens on the demand side. What about the supply side? When companies have to increase their production costs, there's supply shift to the left. When there's stagflation in the short run, output falls, prices rise. Stagflation. You don't want that to happen. That's not good. Long run. If the demand curve is constant, which it usually is, short run shifts to the right, output is natural, and the price levels fall or stabilize. And of course, this is what it looks like graphically. Very similar to what we learned about in the first couple chapters of this course. Very, very similar. We're just adding a few more components in, is all. But at times of recession, times of growth, when there is increase in production costs for supply, the supply shift will be to the left. In the short run, output falls, prices go up. In the long run, output becomes natural level, and price levels will rise. And in the long run, the way that these supply situations are adjusted are based off of policy. And here's a nice representation of that. Isn't that nice? Okay. We made it to the end of this chapter, chapter 20, aggregate supply and demand. Any questions on aggregate supply and demand before we jump into our next chapter? Good? Still awake? Yellow, right? Good on the questions? Okay. All right, let me stop this recording. I'll start the next one here in a second. Thank you.